I'm Jeff Pospisil, the 10-Minute Treasurer with practical advice for improving your church's financial future. So in this video, I'm back in QuickBooks, and I'm going to be looking at what closing entries your church might need so to end one year and begin a new year. And this is different than what QuickBooks calls closing the books. Well, their closing the books is really just password protecting the old data so you don't accidentally post something to a prior year. So we're going to be looking at specifically donor restricted funds, and I'll also touch base a little bit on capital expenses. So if you want your, let's say you purchase a piece of equipment and you want it later reflected on the balance sheet, that's the same process. So let's go ahead and dive into that. So I try to keep my books according to generally accepted accounting principles, or GAAP, and that's because every year I get an audit from a CPA. And I know a lot of churches don't get an audit from a CPA, so you do have a little bit more latitude to probably do things a way that might make it easier to understand. So, but for me, that means what I do for donor restricted funds is I'll keep track of the income and expenses in the non-operating part of the profit and loss. So in that other income section is what I'll do. And then I'll just have the balance right here. So all these ones here are just balances. So apparently for the Builders Club, I had an extra $5,226 of income over expenses. And then this is just the carryover balance. I think it's perfectly fine for a church to run all their expenses and income right out of these equity ones. So if you write a check, it's to that 3105, and if you receive income, it's right to that 3105. That's fine. But the confusing part is actually the retained earnings. You're only allowed to have one retained earnings account, and let me show you how QuickBooks handles that. Let's start by looking at the year-end profit and loss. So I happen to run a July through June fiscal year. And when I look at my total net income, so that's operating and non-operating income, $10,630,000. That's a big number. This is part of a foundation, so we had earnings and donor restricted gifts and all that kind of stuff. So anyway, but keep track of that number, $10,630,000. And now this is the month-to-month comparative balance sheet. So I'm comparing July, the first month in the new year, versus June, the last month in the last year. And so you see my net income, $10,630,000 here. But then you also see this is my retained earnings account. And then this is, again, my $10,630,000. So that is what happens is all your net income gets closed out to your retained earnings fund. And that's the only place it goes. So right on July 1 for me, or for most people, it's going to be January 1, your retained earnings is going to be updated by the amount of your net income. So let's go back to our year-end profit and loss, and you're going to see here's my donor restricted funds, or many of them. And you can see that I had for donations, I had 37,420, remittances 30,170, so I had extra income in that fund of 7,250. So I'm going to need to increase their equity account by that amount. And same for Storm Mountain, I'll increase that one, and Wesley Acres, and then Spirit Lake, I'm going to decrease it because I remitted more money than I actually had, and probably that had to do with extra money that I received the prior year before that. So we keep track of that. And then here would be my journal entry that I'd post. So it would be as of the first day of the fiscal year. So normally it's January 1, but in my case it happens to be July 1. And if you have a net gain in that fund, it ends up being a credit. So here's my Lake Ponset LPC, a gain of 7,250. If there's a net loss in that fund, then you end up debiting it. So I'm going to reduce it by $290. And then whatever the difference is goes to retained earnings right here. One variation that I thought of, and I haven't actually seen it before, but would be instead of recording this in equity account, what if you recorded it to an other income account that showed up as beginning balance for the fund? You'd have to keep in your mind that this is old income, but then it would show up in your report, and your report would then give you a balance right away. And let me show you what this looks like. So here's what it would look like. This would show up right on your profit and loss or statement of activity. Your beginning balance, so this was the balance of the fund at the end of last year, what would normally be recorded in the equity section. but then you get to see the total amount of your donations, the total amount of your expenses, and then the subtotal then ends up being the new fund balance. So you'd always have the fund balance reported right there, because if you do try to track your income and expenses for donor restricted one on your profit and loss, and then you have your equity account, you're always flipping back and forth between reports. So this would give you all the information and a subtotal right then and there. And then this 15,000 here would then be carried forward to next year. So the next fiscal year, that would be the new beginning balance. So I like the idea. I know it's not GAAP, not generally accepted accounting principles, but it might be a useful way of doing things. All right, I hope this was a help to you, and I will include in the description some links to some related funds, one on closing the books, as well as one on donor restricted funds and how to account for them. All right, this is again a ministry of the Finance Office of the Dakotas Conference of the United Methodist Church, as well as the Dakotas United Methodist Foundation. God bless you.